Hello and welcome back. This is the final chapter for Accounting 201. This is financial statement analysis. When we look at financial statements, we want to analyze the financial statements to understand the overall health of the business, the financial health of the business. We'll look at the income statement, balance sheet, statement of cash flows from a perspective of managers to understand the overall financial performance and financial health of the business. To do that, we analyze the financial statements. The reason why we do this is a couple reasons. We need to understand the company's liquidity, solvency, and profitability. Liquidity, as you know, is the company's ability to turn its current assets into cash. Liquidity is the idea behind converting something into cash, right? To be able to be liquid. Solvency is the company's ability to pay its liabilities. Primarily, we'll look at the short-term liabilities. In some cases, we do look at long-term liabilities as well. Solvency is a company's ability to pay its liabilities. And profitability. Does the company have the ability to be profitable? And what are the components we look at for that? So those are the three reasons why we evaluate financial statements for overall financial health of the company. So liquidity. The reason why we look at liquidity is because short-term creditors like banks look at the company's ability to repay its short-term debt. Liquidity. It also looks at the company's ability to convert assets into cash. That's the definition of liquidity. Solvency. This long-term creditors look like bondholders, loans made by banks. They look at the company's solvency. This is the company's ability to repay its debts. Solvency is when we analyze solvency, we're looking at periodic interest payments and the company's ability to repay the face amounts on its debts. And of course, we look at profitability. As an investor, I'm always interested, is a company able to turn a profit? And that also tells us the potential impact on the company's stock price and the company's stock performance. This is essentially looking at the company's ability to generate revenue. That's profitability. There's a couple of techniques that we utilize to evaluate the financial performance of a company. We use analytical methods and ratios. Analytical methods, we look at the percent changes of financial statements from year to year. We utilize what's called a horizontal analysis and a vertical analysis. These are the analytical methods we utilize to look at percent change over time, and we also look at it from a dollar change over time. The horizontal analysis tells me the percent change by line item from year to year. For example, percent change of cash, percent change of sales, percent change of so forth and so on, right? Look at I typically look at the percent changes from a perspective of looking at it for the income statement and balance sheet, sometimes statement of cash flows. And then when it comes to the vertical analysis, I look at things expressed as a percentage to compare against other companies. And then we look at ratios. Ratios tell us overall company health as a relationship to the industry. So either way you do it, whether it's ratios or of other analyses, we're comparing the company's performance over time, that's year to year, or we're comparing company to company, or the company to the industry averages. And the reason why I'm interested in looking at the company's performance is looking at industry averages, it tells me how well the company is performing in relationship to its competitors. Now, as I mentioned, there are a couple of ways to analyze financial statements: horizontal analysis, vertical analysis, and common-sized financial statements. Horizontal analysis, I'm looking at year-to-year changes expressed as a percentage or a dollar amount. And vertical analysis, I am looking at a percentage in relationship to the rest of the financial statement. Now, and we'll talk a little bit more about that here soon. Horizontal analysis, again, is expressed as a percentage or a dollar change in time, right? It's the amount of the increase or decrease and the percentage of the increase or decrease for each line item. Looking at the horizontal analysis, I am comparing year to year. So here's an example of what that looks like. So we have a couple of, this is the balance sheet, as you know, using a horizontal analysis, 2016 compared to 2015. 2016 minus 2015, 550,000 minus 533,000. That's an increase of 17,000 from 16 to 15. And the percent change is 3.2%. You're saying, oh, Dr. B, how do I get the percent change? I hear you. Okay. So here's what you do. You take the new year minus the old year divided by the old year. New minus old divided by old. That gets you percent change. New minus old divided by old. That tells you your percent change. New minus old divided by old. So if this was Excel, I would say A1 minus B1 divided by B1. A1 minus B1 divided by B1. The number you have on the bottom of the fraction or the division is the base. We call it the base. So 2015 would be the base, right? So 2016 minus 2015 divided by 2015. That tells you percent change. And we do this for each line item. That's the concept of horizontal analysis. Think of left to right as the horizon line. That's why we call it the horizontal analysis. New minus old. New minus old divided by old. 2016 minus 2015 divided by 2015. That's horizontal analysis. And we also could do this, again, we do this for the balance sheet. You can also do that for the income statement. And it's good because it tells us a lot about how well we're utilizing our ability to generate revenue. That's why I personally like horizontal analysis. And I usually do run a horizontal analysis on a company's performance before making an investment decision, because it does help. Vertical analysis. Vertical analysis tells us the overall percentage of a component within a financial statement in comparison to the rest of the financial statement. That's a vertical analysis. We perform a vertical analysis on the balance sheet and the income statement. It tells us the overall percentage of what's being utilized. So, for example, on the balance sheet, I take everything as a percentage of total assets. On the income statement, I express everything as a percentage of total revenue. So on the balance sheet, everything is expressed as a percentage of total assets. As you can see, total assets equals 100%. The way I do this is I take my line item, in this example, current assets, divided by total assets is 48.3%. Long-term investments divided by total assets is 8.3%. Property, plant, and equipment divided by total assets is 39%. So forth and so on. You can do that with the rest of the financial statement. Current liabilities divided by total assets is 18.4%. So forth and so on, right? The idea behind this, technically the liabilities and equity, you're using it as a total liabilities and equity. So current liabilities divided by total liabilities stockholder equity is 18.4. Long-term liabilities divided by total liabilities and equity is 8.8. So forth and so on, right? The idea behind this is we are looking at how much utilization we have in our assets and our liabilities. Utilization. If 48.3% of my total assets is within current assets, that tells me my current assets are a focus point of my business. That would be things like your cash, accounts receivable, so forth and so on. Lakeisha, what do you think?
Yes. Okay. I was working on this, and I see how everything is coming together and it's adding up. So I just have to make sure everything know what I'm basically have to just know what I'm adding and know what I'm subtracting.
Yeah, and then for the when it comes to the analysis components, it's a matter of knowing what you're dividing, right? And so for example, going back and looking
So
at
this part we're dividing on this. So I'm dividing on this. So does it tells me when you're dividing and when you're adding? Because it doesn't like say it just adds everything up and then it just puts the numbers like to the side. So it's like, okay, I'm just thinking that they're adding, and then at the bottom now I see that that's when you're subtracting or you're adding at the bottom. So you add everything up at the top, but at the bottom you're subtracting or you're adding. Like you said for this one, you're dividing. So I
right, yeah,
basically just didn't know what you're doing, what operation to do.
exactly. It depends on what the objective is. So, like for example, when we're doing a horizontal analysis, we're looking at it as a change in dollar amount and expressed as a percentage. So to get the change in dollar amount, it's just a matter of taking the new year minus the old year. 2016 minus 2015 gets you the change in a dollar amount. When you express it as a percentage, in order to get a percentage, you need to divide. And so to do that, to get the percentage, we take the new year minus the old year divided by the old year. And that gives you the percentage. And that's for horizontal analysis. When it comes to the vertical analysis, we express everything as a percentage. Now the percentage is a little bit different for vertical analysis because the percentage is based, for the balance sheet, it's based off of total assets and total liabilities and equity. That's why you see it expressed as 100%. In order to understand what the percentage is of current assets, for example, we take current asset amount divided by the total asset amount to get the percentage of current assets. And you do that same process for all of the assets. And then for the liabilities and the equity, you would take that line item, like for example, current liabilities, divided by the total liabilities and stockholder equity. So you take your current liabilities divided by your total liabilities and stockholder equity to get the percentage of total current liabilities. And you go through that process. So that's why it's important to know, how that formula works, right? Especially when it comes to analysis. On the income statement for vertical analysis, we express everything as a percentage of total sales or total revenue, whichever one it says, right? So total sales. We have total, in this example, we have total sales expressed as a percentage, as a dollar amount and as a percentage. Total sales 1.48 million, that's 100%. To get everything else, we simply take that line item and divide it by total sales. So in this example, cost of goods sold divided by total sales is 69.6%. Gross profit divided by total sales, 30.4%. So forth and so on. And you do that for every line item on the income statement. And that's vertical analysis. Another way of analyzing financial statements is to use common size statement analysis. This is oftentimes expressed as a percentage with no dollar amount shown. Common size is useful for comparing company to company or from company to industry. Here we have two competitors. We express everything as a percentage, sales 100%, and then we go through the same process. The only difference here is with common size statements, we're not looking at the dollar amounts. We're just looking at it as percentages. And the reason why we do that is it helps us to understand if we're competitive, and it tells us if we are in line with industry averages. Now, in business, we also want to understand the company's ability to be liquid, which is how quickly we convert things to cash. And to do that, we perform ratio analysis. There's a couple of liquidity ratios to identify the company's ability to quickly turn things into cash. Those would be things like working capital ratio, current ratio, quick ratio, asset account receivable turnover, number of days of sales, inventory turnover, and number of days of sales and inventory. Those ratios, as you compute them, those all contribute to liquidity ratios. And as you know, liquidity is the ability to convert something into cash, how quickly you convert it to cash. We can use what's called a current position analysis. This tells us the company's current ability to pay its current liabilities. And to do that, we look at short-term information, and we will compute things like the working capital, current ratio, and quick ratio. Working capital, as you know, is a part of that liquidity ratio. To figure out working capital, we simply take our current assets minus our current liabilities. As you know, both of these are found on the balance sheet. Current assets minus current liabilities, that gives us working capital. Current assets minus current liabilities equals working capital. And you can compare year to year the working capital amount, 2016 comparison to 2015. And it tells us the company's ability to pay its current liabilities. I typically look at a working capital monthly, quarterly, or yearly, depending on the creditors and the debtors. And I also can take into consideration the use of working capital in comparison to other companies. Another important ratio to understand, as you know, is the current ratio, also known as the working capital ratio. we take our current assets divided by current liabilities. And this gives us a percentage, current assets divided by current liabilities. And the higher the current ratio, the better. It tells us how well we are utilizing our assets to repay our current liabilities. There's also what's known as a quick ratio. This is a very quick way to determine the company's ability to repay debt. This is also called the acid test ratio. Again, the word quick is the idea here. We take our quick assets divided by current liabilities. Quick assets, that is cash and cash equivalents. A quick asset is cash and cash equivalents. So it's cash and other current assets that will be quickly converted into cash. Quick assets include things like cash, temporary investments, accounts receivable, but they exclude inventory and prepaid assets. So in other words, cash and cash equivalents. That would be cash, temporary investments, and accounts receivables. Those are called quick assets because I can quickly convert those into cash. So quick assets divided by current liabilities is the quick ratio. And that helps me to compare my company against other companies to tell me how quickly I can convert things into cash. Accounts receivable analysis. This tells me how quickly my customers are repaying their debts to me. When you purchase something on account, eventually I expect to receive cash, and the accounts receivable analysis helps me to figure out how quickly the company, am doing that. And I would compute things like the accounts receivable turnover and the number of days sales in receivables. What was I going to say? Collecting on accounts receivable quickly helps the company to improve the company's liquidity. It also provides cash to improve or expand operations, and it reduces risk of uncollectible debts. Those are just benefits of quickly turning your accounts receivable. Oh, sorry. The accounts receivable turnover is calculated by taking your total sales and dividing it by your average accounts receivable. To get your average accounts receivable, you take your beginning year accounts receivable plus your end year accounts receivable and divide by 2. And that gives you your average. Beginning plus end, divide by 2. Beginning plus end, divide by 2. That gets you your average accounts receivable. So you take your total sales divided by average accounts receivable to get you your accounts receivable turnover ratio. And again, it's very similar. The higher the ratio here, the better off you are utilizing your accounts receivable. How do I figure out the number of days my accounts receivable has been sitting there? You take your average accounts receivable, again, that's beginning of the year plus the end of the year divided by 2. That's your average accounts receivable divided by average daily sales. To get your average daily sales, you take your total sales divided by 365. That gets you your average daily sales. So average accounts receivable divided by average daily sales gets you your number of days in sales receivable. The lower the number of days receivable, the better. The lower the number of days in receivables, the better. That tells me the average number of days it's spending in receivables. And I don't want my cash to be sitting in receivables because that doesn't help the business to grow. You want to be able to turn the receivables over. That's the idea behind it. Another important thing to analyze is the inventory of the business. If a company has too much inventory on hand, it's not turning it over quickly enough, those are things that can really hurt the business. So that's why it's important to understand things like inventory turnover and the number of days of sales in inventory. Excess inventory decreases liquidity, it ties up cash. It's just not good to have too much stuff tied up, right? It increases insurance expense because you have too much stuff sitting on your shelf. It also increases the loss because over time the inventory becomes obsolete. So we want to turn our inventory over as quickly as we can. We don't want things sitting on shelves and lasting forever and then eventually either throw it out or sell it at a loss. So inventory turnover, we calculate that by taking the cost of goods sold divided by average inventory. To figure out average inventory, we take beginning of year inventory plus end of year inventory divided by 2. So cost of goods sold divided by beginning of the year plus the end of year divided by 2 equals our inventory turnover. And of course, I want to figure out how much time my inventory is spending on my shelf. How do I figure that out? I take my average inventory, which again is beginning of the year plus the end of the year divided by 2, divided by the average daily cost of goods sold. Figure out average daily cost of goods sold, take your total cost of goods sold divided by 365. So again, average inventory, beginning of the year plus the end of the year divided by 2, divided by average daily cost of goods sold, that is cost of goods sold divided by 365, to get me my number of days of sales in inventory. And of course, the lower the number, the lower the daily sales in inventory, the better. Because it shows me how long it's taking for something to get sold, right? That's the idea. What about solvency? Again, solvency is a company's ability to pay its long-term debts. There's a couple of solvency ratios you should know. The ratio of fixed assets to long-term liabilities, the ratio of liabilities to stockholders' equity, and the time interest earned. I think we covered time interest earned in a previous chapter, but it comes up again, right? Once you get the basics of understanding the ratios, what's being divided by what, it becomes second nature. You'll become good at it. You just got to practice. Okay, the ratio of fixed assets to long-term liabilities provides a measure of how much the fixed assets of the company are being used to support its long-term debt, and it tells us the company's ability to repay the face value of the debt. To figure out this ratio, we take our fixed assets net amount. That's our total fixed assets. Remember, fixed assets, property, plant, and equipment. Property, plant, and equipment divided by long-term liabilities equals the ratio of fixed assets to long-term liabilities. Property, plant, and equipment divided by long-term liabilities gives me the ratio of fixed assets to long-term liabilities. Another ratio to know is the liabilities to stockholders' equity. It tells me it's the leverage of the company. It's kind of like a margin of safety, right? How much wiggle room do I have? How much protection do I have? That's a good one to know. To calculate this, we take our total liabilities and divide that by our total stockholders' equity. As you know, both of those are found on the balance sheet. Total liabilities divided by stockholder equity gives me the ratio of liabilities to stockholder equity. The lower the number, the better. Lower the number, the better. Times interest earned, we learned about this one in the previous chapter. Sometimes called the coverage ratio. It tells me the company's ability to make interest payments. We take our income before income tax plus the interest expense and divide by interest expense. All three of these items are found. Both these items, income before income tax and interest expense, are found on your income statement. Income before income tax plus interest expense divided by interest expense gives me the times interest earned. And of course, we want to figure out, is the company profitable? What is the company's ability to be profitable? And to do that, we calculate a couple of ratios. Asset turnover ratio, return on total sales, return on total assets ratio, return on stockholders' equity, return on common stockholders' equity, earnings per share, price earnings ratio, dividends per share ratio, and the dividend yield ratio. We expressed this one before, asset turnover. This tells me how quickly I'm turning over, how quickly I'm utilizing my total assets to generate revenue, which is a profitability ratio. We take our total sales divided by our average total assets, excluding long-term investments, average total assets. Long-term investments, those are things like holding a piece of land that I plan to sell in the future. That's a long-term investment. We don't consider those when we look at asset turnover because we're not utilizing that piece of land that we're holding for sale later on to help us to generate revenue. That's why we don't consider that. So again, we take sales divided by average total assets. How do you get average total assets? Beginning of the year assets plus end of year assets divided by 2. So sales divided by beginning of the year plus the end of the year divided by 2 to get us to our asset turnover ratio. Return on total assets, this helps us to understand how much of our assets are financed. In other words, if I were to purchase my inventory on account, when it's on account, it's being financed. And remember, if it's net 30, you pay it late, there's an interest, there's a, so forth and so on, right? Return on total assets tells me how much my assets are being financed. To figure that out, I take my net income plus interest expense divided by average total assets. Net income and interest expense are on your income statement. Average total assets, you take your beginning year plus your end of year divided by 2. And as you know, assets are found on the balance sheet. Net income plus interest expense divided by average total assets to get our return on total assets. The higher the return on the total assets percentage, the better. Return on operating assets. This is computed by taking your non-operating income and expenses. This basically tells me it's a profitability component. It basically tells me how well I'm operating. To do that, we take our income from operations and we divide that by our average operating assets. It's not as common. It's really not as, I rarely ever calculate that one because it's not as helpful as the other ratios are. Just my opinion. What about equity? So, as you know, investors like to get paid back. So do the owners. So what they do is we look at these types of ratios. Return on stockholders' equity. Return on stockholders' equity is we take our net income divided by our average total stockholders' equity. So figure out average stockholders' equity, beginning of the year stockholders' equity plus the end of the year stockholders' equity divided by 2. Net income divided by average stockholders' equity equals the return on stockholders' equity. The higher the percentage, the better. Let's talk about leverage real quick. I mentioned this word earlier on. Leverage is is where we use debt to increase our total return on investment. to calculate how much we're being leveraged, we take return on stockholders' equity divided by the return on total assets to get the effect of leverage. Now, again, the effect of leverage basically tells me how well I'm using debt in order to increase my assets or increase my sales. Then we have return on common stockholders' equity, common stock, return on common stock. That's another way of saying it. We take our net income minus preferred dividends divided by average common stockholders' equity. Just as before, to get an average of pretty much anything, you take beginning of the year plus the end of the year divided by 2. So net income minus preferred dividends divided by average common stockholders' equity equals your return on common stockholders' equity. The higher, the better. Earnings per share. Earnings per share tells me for each share of common stock that's out there, what is the average earnings on each share. To figure that out, we take our net income minus preferred dividends divided by shares of common stock outstanding. Net income minus preferred dividends divided by number of shares of common stock outstanding gives our earnings per share. Earnings per share, higher the better. Almost done. We have price per earnings ratio. Price per earnings ratio on common stock measures the company's ability for future earnings. To figure this one out, we take the market price per share of common stock, divide that by the earnings per share of common stock. Market price divided by earnings per share of common stock gives us the price earnings ratio. Dividends per share ratio. This tells us the company's ability for distributions to common shareholders. To figure that out, we take the dividends on common stock divided by the shares of common stock outstanding. Dividends of common stock divided by shares of common stock outstanding gives us the dividends per share of common stock. Again, higher the better. This is a nice visual representation. Dividend yield. Dividend yield on common stock measures the rate of return on common stock to shareholders from cash dividends. This one's kind of special. But it's a nice one to compute. We take dividends per share of common stock divided by the market price, and what that does is it tells us the overall percentage of the dividend that gets paid out. These last 3 slides here, these are nice to look at. They're definitely going to be great to look at as you are working on your final exam. On the final exam, you'll be asked to, there will be very few computations you'll need to make. The ratios are spelled out on these last 3 slides for this presentation. So make sure that you look at these PowerPoint slides for your final exam. They're kind of like your cheat sheet or your quick reference, whatever you want to call it, with respect to how do I compute the ratios. These 3 slides, super important. It's a summary of each ratio that we went over, and it tells us how to compute each one. And that brings us to the end of Chapter 14 and the end of the course. Are there any comments, questions, concerns that I can help to answer at this time? Lakeisha, Drew, Narciso, any questions at all? I hope this was helpful.
Oh, Professor, no, this was helpful. I told you I'm gonna reschedule my meeting because I forgot class. Today I'm gonna reschedule my meeting. But this was very helpful. But what I'm gonna do is for the homework or for the question that I have for you is email you about that,
Sure.
And so you can help me. How can I answer that question?
Absolutely. Yeah, it'll be my pleasure to help. Absolutely.
Okay, and
That's
I
what I'm
told
here
you I'll
for.
reschedule our meeting.
That sounds good. Yeah, whatever works.
Okay.
Just hop on that link, the office hours link, and then just schedule a time.
Okay, I sure will. Thank you so
Sounds
much,
good.
Professor. I appreciate everything, all your support, all your help. You have really helped me through to get through this semester. It really wasn't like overwhelming for me, and I appreciate all of the support and resources and everything that you have given us. And I'm just so thankful to have had you this semester because it have really has been a trying time, but I appreciate you just working with all of us individually and collectively, and I just appreciate your patience and your understanding.
Absolutely, my pleasure, Lakeisha. And are you have you registered for 202 yet?
Yes, Dr. King already registered me. He already registered me. I'm already signed up. It's already on my courses, already on the schedule and everything. So I'm ready to go. Yep, I'm already.
Fantastic.
Yeah, yep. He made sure I was in there. Yeah, he was on it. Dr. King was on. I thank him and Professor Cook so much because they
They're
they
wonderful.
have been on it, like really making sure that
Yeah,
we get that we succeed and we get up out of here. They really
that's
want
right.
all of us to succeed, and
That's
they
our
really want
objective.
us to get up out of here, to move on to bigger and better things. And I appreciate all of you guys' support and everything. I
Yeah,
really do.
that's our objective is for you all to be successful in life, and that we're providing you with the tools that you need to do so.
Yes, sir. Yeah.
Especially in business. That's my goal in life is
Yeah,
to help you all.
and I appreciate it. You are my mentor. You better know you is my mentor. I'm
Right on.
calling you out. You sure is my mentor. I'm already calling you out.
Awesome. I appreciate that. I really do.
Okay, okay, Professor B.
All right. So I'll see you soon then.
Yeah, you'll see me soon. Okay.
Okay. Catch you later.
Okay.
All right. All right. Bye bye. Drew Osman, are both of you okay? Are there any comments, questions, or concerns?
I'm okay. Thank you, Professor.
Wonderful. Thank you so much.
Oh,
If you ever need anything, you let me know. Okay.
sure. Thank you. I appreciate.
Sounds good. And I see you're doing very well, so that's good.
I try my best.
I know you do. You're getting it.
Yeah.
I know you are.
I'm I'm at work now, but I'm the class,
Oh, okay.
working and also in class.
Hey, sometimes you just got to double task. I understand.
I know, yeah. But
Or-
thank you for understanding.
hey, I get it. So yeah, if you ever need anything, you just let me know. Okay.
Sure. Thank you so much. Have a
Okay.
great day.
All right. You too. Take care.
Take care. Bye.
All right. Bye bye. Drew, you're okay? I'm gonna go ahead and end the meeting now. All right. Take care, y'all.